Hey, good morning, everyone. It's just gone live, and there's a few people coming in already. Hey, Lee, how you going? Hey, Jatine, Mark, Tom, awesome. Hey, just triple checking my audio. If you could just raise a hand on that on your panel there, just so I know you can hear me. Sweet. All right, I'm getting some feedback. Thanks, Lee. Awesome to see you here. Wonderful. All right. Well, we're going to get started pretty quickly this morning, and there's probably going to be a few people join as we go, but that is all good. We will also be releasing the recording to anyone who registers. So if you miss a bit or you have to go off early, that is not a problem at all. We will send a link out afterwards for that. And I guess the topic of today's webinar is all about the federal budget update. So I guess before I sort of get into it, the federal budget's usually released on I think it's the first or the second Tuesday in May. But thanks to the lovely COVID that came along this year, they postponed that right through to the 6th of October, which was actually Tuesday night this week. And so what I've done in this webinar, or my goal for this webinar, is actually to distill the masses of information, and there's lots in the budget, but this is what I reckon is relevant to business owners, individuals, high income employees, self-managed super funds, and there's actually not a lot for SMSFs, and there's also not a lot for investors, but I will kind of kick on cover my sentiment for those groups there. So there is tons for business owners, absolutely tons of good news, which is fantastic. Alrighty, well let's get into it. I'm recognising a lot of names in the attendees, but for those who don't know me, my name's Ben Walker, and I started an accounting firm, Inspire, when I was 23 years old, actually, and we're based in Brisbane, just in the Fortitude Valley, a few minutes out of the CBD. I guess something that we're pretty proud of as a team is that April, May, June was a pretty tough quarter for businesses and people in general, but we were able to put over $7 million back in the hands of our clients thanks to JobKeeper assistance that we gave them, cash flow boost, and also tax savings, which is pretty impressive. And I can't do that stuff alone. Here's a picture of our awesome team, growing team, who have helped me achieve that sort of stuff. So I just want to give them a bit of a shout out here. Also, I do want to sort of mention that this webinar or webinars are better for me and hopefully you as well if we do interact. So there should be a panel for you, a Q&A panel, where you can send through a question, and what I'll do is I get a little notification when someone sends something through, and I'll stop and answer those as we go. Anything that I might have coming up, I'll just flag that if it's not the perfect time to answer that question. Alrighty, so as I mentioned, there's going to be a couple of topics I'm going to cover this morning. We've got high income employees, business owners, and in fact the bulk of today will actually be focused on the measures for business owners, which are very, very extensive. There's a short mention on SMSFs, and in fact there's really nothing on investors. There's no sort of key changes from an investment perspective, apart from a little small rule on capital gains tax and granny flats, which I don't think is going to be too widespread, but if you want to know more on that, then just shoot me a note. Otherwise, I actually won't touch anything on investors because there's not much to go there. Also, if there's anything further that you'd like to chat through about the budget or even just your accounting in general, there is a way that you can get in touch with our accounting team, and it's just that link there, inspire.business/chat, and you can book in there's no cost to it, a 20-minute phone call with our team if you just want to bounce some questions off them or need further help that you're not quite getting at the moment. So in terms of the overview of the budget, I guess the intention is to bounce back as quickly as possible from the negative effects of COVID from an economic perspective. I saw Scott Morrison on some news thing this morning. He's saying that the results of the dip in the economy globally are worse than the GFC, like 45 times worse than the GFC side. And so that's an incredible dip compared to something that was shook up the Australian economy a few years ago. But I guess what they've encouraged is more spending, especially for businesses. They've done extensive stuff with what they're calling the Job Maker program, driving jobs and also hopefully increasing confidence in the market in general. This budget, I guess it's good for young people and business owners, and anyone still working is going to get probably up to a couple of grand in their pockets, which is pretty fantastic. And also, there's nothing directly for investors or self-funded retirees, but the indirect effects of higher spending driving jobs and confidence should be, if you're invested in the share market, should be an indirect return in uplift in the market value of our share market. So that's a quick overview. Now I'm going to go into the different topics that I guess the different subjects that were announced. Also, keep in mind that this is just announcements at the moment. It's kind of not gospel until they write it into legislation and it receives royal assent. So that usually comes following in the weeks or months following the budget release when they make this stuff into legislation. And there's also some topics in here that they're not even confirmed yet. They want to do X, Y, or Z, and I'll flag the one I can point out there. They're saying, look, they're going to consult on it first before they turn it into a reality. So, but these ones are pretty solid. Actually, self-education, So the first one here is one of those things where they want to consult first before they turn it into a reality, and that's the ability for employees to claim self-education expenses for something that's completely unrelated to their current employment. So at the moment, if you're a high-income employee or an employee and you want to claim some study, it needs to be keeping up with your skills for your current work, or leading to increases in pay rises and things like that. So this is like an accountant going and studying engineering and being able to claim engineering courses. There is some caveats to that, and I think it's got to do with sort of Commonwealth supported stuff. So it might be more so third party trainers or not university style studying, where you get sort of HECS or help or discounts if you're a citizen. So that's going to be cool. Also, tax rates. So there's been a big shift or a pull forward in the proposed tax cuts that were released a few years ago. They've pulled forward and they're actually retrospectively applying that from July this year onwards. So that's going to be the biggest update in terms of individuals. So the tax rates here, sorry for so many numbers on the screen, but I'll just walk through. On the left-hand side is what we currently were on, which is the tax rates up until what we heard on Tuesday. The first 20 grand, there's no tax on that. There's actually no change in that one there. So your tax-free threshold is untouched. But these two here have had significant changes. These two tax brackets from 18 grand to 37 grand has changed from 18 grand to 45 grand. So we can earn more income here before we jump to the next tax bracket, which is great. Similarly, the 37K to 90K tax bracket has gone from 45 to 120, which means that often as business owners, when we're doing tax planning, we used to have a $90,000 magic number before we want to send, profit or something like that to a bucket company. But now our magic number looks like it's increased to $120,000. Also, keep in mind these tax rates are excluding Medicare levy. So, instead of 32.5%, you're looking at 34.5%. There's a 2% Medicare levy there. But that's pretty exciting. And I do think there's definitely more tax cuts on the way in future financial years. But this actually applies from the 1st of July, 2020. So if you are an employee and you're in these ranges here, then you might notice a slight pay increase on your next payslip, which is, pretty cool. Alrighty, we will keep moving. So another way to sort of visualize or quantify, the changes in the tax rate is we've got like 2020 financial year, so last financial year's tax liability, comparing it to this current financial year's tax liability. changes and at different income levels. And sorry, there's an arrow over the anyway. It's there. So $40,000, if that's your taxable income, you've got a 12.9% decrease in the actual tax bill that you pay. And sorry, the one you can't see here. There we go. So let's say you're on 100 grand. You were paying 25.5K in tax. Now that's dropping down to 24, so you get a $1,500 discount on your tax bill. Now I've sort of visualized it here. You got, let's say you got two adults on roughly 90 grand each. You're looking at a $1,500 tax saving per person, which is $3 grand for a household. That's not too bad, I reckon. So especially when our magic number has been about that 90K mark, and I think that's roughly the average teacher's salary as well. So that's the income tax rates for individuals update. Now we're into the business owner section. And there's actually, I think, about 7 key things I want to bring up. There is more that was released in the budget, but I don't want to cover absolutely everything. This is just the key stuff that I think is going to apply to the majority of our clients. So this one's the tax loss carryback. Now, if your business is making losses now because of COVID, what they've said is if you're structured as a company, then you can actually go and offset your 2020 financial year or 2021 or 2022. So that's the notes here. So last financial year, this financial year, and even next financial year, if you're making losses, then you can go and offset them against prior year gains and tax paid. This is fantastic news if you're in the unfortunate position of making losses at the moment. And I guess to quantify that arrow is quite frustrating. There we go. So normally tax losses are only carried forward. We can't go and apply them against previous profits. So an example of this is, let's say you made 100 grand loss in the 2020 financial year, but you had a profit of 200 grand in 2019, the year before that. Then you can basically reduce your 2019 income by 100 grand. And if you're a small business, you'll get 27.5 grand as a tax refund, which is, pretty substantial. Yeah, that's handy. Now, if you are structured as a trust, again, a reminder that doesn't apply to you or a sole trader or partnership, unfortunately, only company structures. And just another invitation to use that Q&A box if you do have questions. It's pretty quiet there. And Lee, thanks for your note on the Granny Flat stuff. I'll send you a message afterwards with that info. Number 2, the immediate asset write-off. So this applies to assets like cars, laptops, computers, machinery, assets that you purchase in your business that under normal rules, you can't actually write off as soon as you buy them, like consumables. You'll actually have to write them off over a number of years. Now, the limit on this has changed so much in such a short amount of time. It's incredible. And I'll show you like the current progression of it. We had 2016 to roughly 19, we had a 20 grand limit and your turnover changed between that point. So under 2 mil it was originally, now it's up to 10 mil. Then in 2019, we had 2 rates. Now we had 2 rates, which was 25 grand, and then it went up to 30 grand from April through to June that 2019 year. And it stayed at 30K for even into 2020 when COVID hit. And then when COVID hit, they changed it up to $150,000. And it says from 1 January 2021 here, $1,000, which I actually don't think that they'll change it before we get there again. But the $1,000 is the normal limit, and they've, like, for ages they've just topped it up to or increased the instant asset write-off to quite substantial amounts. So this is what we were. Now the budget's changed this again, and also I can see a question from Tom. Hey Tom. Now this this depreciation doesn't apply to property. That's a separate set of rules in terms of claiming your construction cost, which, as far as I'm aware, hasn't changed, and you still claim construction over 40 years. So 2.5% a year, which is not a high deduction. But this would include things like, fitting out like let's say you're a dentist, to fit out a dentist's room can cost $80,000 to $100,000 of equipment. It's that sort of thing where, they're assets that you'd write off, or, furniture, computers, that sort of stuff. Cars even, although just watch with cars, you do have a car limit as well if it's like a passenger car, not a commercial vehicle like a bus or a truck or a ute. So these are the current amounts. Now, what do they change them to? It's incredible. So there actually is no limit anymore. It's, if you want to spend $1 million on a truck, you can claim the whole thing, or a bus. And there's a few bus-related people on the call today. You can buy a $700,000 bus and claim the whole lot. So it is pretty cool. Now, in terms of the eligibility for that, that's under 5 billion. That's not a spelling mistake for million. That's $1 billion in turnover. And you need to buy the assets between 7th of October 2020 to 30 June 2022. And I might just add, it's for new depreciating assets, unless your turnover is less than $50 million, where it also includes second-hand assets. So that's going to be the most people. Where the turnover is probably on this call. Most people's turnover is going to be less than 50 mil, so you can buy second-hand assets and still be eligible for the no limit thing. And it also includes improvements to existing eligible assets. Now, there's a couple of questions coming through. Alan, actually, I might get you to give me examples of what you would like me to consider there, which you have done. In terms of eligible assets, like you've asked whether intellectual property can qualify. My answer to that is no. It's more so physical depreciating assets. And I gave some examples there, like computer equipment, or furniture if you're an office-based business, manufacturing plant and equipment for other type of businesses, or buses, vehicles that aren't caught under the car limit, that sort of thing. Mark has also asked about, you would obviously need profit in excess of the full claim. So Mark, that would make sense if you're going to look at using this as asset write-off, that you would have the profit to offset your purchase. But if you do purchase something like a $700,000 bus, then you can actually write off and create a loss out of this. That's our understanding at the moment. Now, would that make financial sense? I don't know. It depends on your circumstances, and also, like, you could carry forward a loss to future years, or again, let's combine this write-off. If you're structured as a company, you might want to create a $500,000 loss to go and claim back some tax from prior years. Like that's kind of, you start stacking these announcements, and you might actually get a bit of money back straight away, instead of waiting until your next tax return or the next financial years to write the loss off going forward. Felicity's asked, I missed what you said about the office fit out, allied health, occupational therapy gym. So Felicity, the guidance with a fit out, like the actual construction and fit out of a building, so things you can't move, like walls and glass panels and reception desks that are built out of the ground, that sort of thing. Unfortunately, we've got to claim them over 40 years because they're fittings, rather than things like air conditioners or dishwashers and stuff like that, where they do have an effective life of a lot less than 40 years. So if you are looking to spend on fit out, these rules don't apply. It's more so the equipment and that sort of thing. Alan, I'm not quite understanding your question. You said nothing capitalized that is amortized. Is it applicable for personal services business as well? Jen, I'm not sure exactly what you do, but if you do fall under even a personal services business, you should be okay with this stuff. As long as, like, if you're putting it through an ABN, you should be fine. Mark, so a tech play like employee metrics development would not need to be included. Again, Mark, I'm not quite sure what you're referring to there. If you're able to just sort of reword that one. Mark, company situation sounds good. Yes, with the loss, like the carry back losses, usually it's referred to as carried forward, but the carry back losses plus this thing is looking fantastic. Otherwise, if you're a trust, and a lot of our clients actually trade as a trust, then you need to carry those losses forward. Mark, sorry, just in terms of your question, are you saying claiming the expenses to develop an app or SaaS system? I just need probably the full question again. Sorry, mate. Cool. Now, a related, what would you call it? A related announcement is the ability to deduct your pool. Now, I don't mean actually going and building a home in your backyard, but under the simplified depreciation rules that are allowable for small businesses, then you can actually deduct your closing balance of your pool. Now, this has been around for ages, but it goes in line with, and I'll go back a few slides, the deduction of the pool is limited by what the instant asset write-off is each year. So, and what I mean by closing pool balance is if you were to buy $100,000 asset, let's say it's a piece of machinery. Now, if you can't instantly write that off because you purchase it over the limit, you actually have to write that off under special rules, which is claiming 15% in the first year and then 30% every year after that. So let's say year one, you buy $100,000 asset, it's now worth $85,000. So that $85,000 is what we call your closing pool balance, because plus all the other assets that are written off over time, they all add up in your closing pool. Let's say your closing pool was $85,000. Under previously, we couldn't claim them until that size pool balance until the 2020 financial year, because that's when the instant asset write-off was over the pool balance of 85K. Now, what we kind of get access to with writing off your pool is, because our proposed limit of the instant asset write-off is now infinity, it is not limited, then they're basically saying you can write the whole thing off. If your turnover is less than $10 million, you can just claim the whole thing. Now, I do want to say there's a little bit of a warning here. It is now optional. It used to be forced. So we were getting a little bit concerned that we're going to have to be and forced to be write off everyone's pool balances at the end of the 2020 financial year. And the reason why I'm concerned is the banks don't like losses. So let's say you're forced to claim that $85,000, which takes you into a loss. That's not going to look great for a bank when you go for finance for a property purchase. So it is an optional claim now. Now, this, if you are in a decent level of profit, and a lot of businesses are even during COVID, especially because things like JobKeeper are actually taxable, then this might be something you need to consider, and it will mean a huge difference for your sorry, I'm just half reading the questions. And I lost my train of thought. Cool. Anyway, I might go to the questions. Sorry, just with those losses in the banks, if you're going to purchase a property or something like that in the future, you just want to make sure your taxable income's not showing as zero, because that's going to be quite difficult to get finance. And I don't mean make it up, but this is one of the ones where you might want to say, look, I'll actually not apply this measure. Otherwise, I'll be in too much losses. So I'm going to just jump back to the questions. So Mark, you've said the expenses to develop the app or SaaS. Yes, they are tax deductible, those expenses, but that's not under the depreciation rules. They're kind of deductible in any case. Mark, the NTA states that the company loss carryback applies from 2020, 21 and 22. Previously tax profits made in or after the 2019 financial year. Can you confirm the years that it can be claimed against? Well, that's exactly so what the NTAA have said. Sounds correct. And I've just got one other source. If you could just give me one moment, I'll double check that they're on the same page. Carry forward to previously taxed profits in 2019 or later income years. So yes, that what you've suggested there, Mark, is the years that I can confirm from another source. What if the general pool balance includes a luxury car? So with luxury cars, we can only claim up to the deductible car limit in general. So let's say you buy a car that's more than that limit, we can only claim the limit, unfortunately. And in terms of the general pool balance, yeah, obviously up to that limit. And the limit, if you would like to know, I'll have to look it up because that's something that bloody changes all the time. Car depreciation limit. So in the 2021 financial year, depreciation purposes, we're looking at $59,000 or $59,136 in your car depreciation limit. Alrighty. So moving on from depreciation related stuff with the business measures, we've got the job maker hiring credit. So this is pretty exciting, although at the same time, it might be a touch hard to actually be eligible from an employee perspective. So it kind of needs, like JobKeeper, it kind of needs your business to be eligible, and I'll go through what that means, and then also your employees, which might be the harder thing. So anyone hired from the 7th of October, and you get this credit for 12 months. So it's pretty exciting. It's in a similar sort of vein to JobKeeper, where you get almost like a subsidy on the wages. It's $200 a week. And this is your age range. This is age-based, and it's aimed at younger people. So for people aged, employees you hire between 16 and 29 years old, you're looking at a $200 a week credit. And then age between 30 and 35, you're looking at $100 a week credit. There's no fall-in turnover test for this, so it applies to people who haven't received JobKeeper, and you claim quarterly in arrears from February 2021 onwards. And just reading between the lines in the announcements, it's probably going to be similar to how we claim JobKeeper in the business portal or the tax agent portal. So what does it mean to be eligible? All right, I'm just going to move my screen around to get that circle off there. So employer eligibility, these is key criteria. I've taken some out because it's almost like you have an ABN. Seriously, if you run a business, you have an ABN, or you should. So you need to be up to date with tax lodgements. So you can't have any overdue or outstanding tax returns. You also need to be registered for pay-as-you-go withholding, which is a requirement of employing people. You need to report payroll through single touch payroll. So that's been I guess a requirement for a little while now, with a couple of exemptions, but you do need to be registered for single touch payroll. You also need to meet the additionality criteria. So what that broadly means is that you can't just fire half your workforce and replace them with people who meet the eligibility conditions. So if you've got 10 people, you can't fire 5, hire 5, and then be eligible. You need to increase your headcount to be able to claim. Nice one, Steve. So I'm just looking at the Q&A box. It's a little bit distracting, but now the other one is you have kept adequate records. So you also need to pay them at least 20 hours a week. So they can't be like casuals on a few hours to be able to get this. And you need to keep records of this stuff, which, if you're using something like Xero or like a payroll software to pay them, it should be pretty easy to do that. Now, in terms of the employee eligibility, so it needs to be within 1 year of the relevant age ranges in their first year of employment. So they need to be in the age range. It's a pretty straightforward one. Have worked at least 20 hours paid per week on average for the full weeks they were employed. have commenced their employment between 7th of October and the 6th of October 2021, so next year. So it's basically available for a year, and it's the employee's start date plus 12 months for this to happen, is when you get your reimbursement or your subsidy there. Now we've got, now this is the key one, and this is going to be kind of tough. You can't just hire anyone for this to be eligible. We've got have received the JobKeeper payment, youth allowance, or parenting payment for at least 1 month within the past 3 months before they were hired. So what we're kind of looking at there is, let's say someone works in tourism or hospitality, ended up losing them jobs. There's more industries than that, I know, but you know, that's an easy kind of thing to say, yep, lost my job. They're on Job Seeker looking for another job. You hire them. Yes, they've received Job Seeker within the last 3 months when you hired them. That ticks that box there. And they need to be employed on a permanent, casual, or fixed term basis. But again, keep in mind at least that 20 hours a week on average. So that's that one there. Again, just referring to the Q&A boxes there. Yes, Steve, you do need your tax returns done to be able to claim this one. And also making sure your BASs are lodged on time. That was a problem with, I think it was Cashflow Boost, where if even BASs weren't lodged on time, it caused issues with accessing that. Jatine, you've asked what is the date range again? So the date range for them commencing employment is any time from basically Tuesday night, the 7th of October, just this week, until the 6th of October next year. So you've got to start their employment between those dates, and then you can claim your credit from that point onwards for up to 12 months, as long as you meet all the conditions here. How do you go about it recruiting these employees? It seems very discriminatory to advertise for certain age. You have a very good point, Alan. Geez, you are 100% correct. You can't really ask someone how old they are when you employ them, can you? As well as someone who has received, there's a interesting point, and I don't have an answer for you, Alan. It's just a reality of how this is of how this is written. That's very interesting. Thank you for bringing that up. So I reckon this is pretty exciting because it's kind of like a light version of JobKeeper that might extend even further for giving people jobs. So yeah. And also just jumping back to the additionality criteria, maybe this is for Steve or anyone else who's who's let people go or considering hiring people and all that sort of stuff. I'm pretty sure your start date for your additional headcount starts at the end of September, from memory. I can look that one up if it's of interest for people, but yeah, it's a complex one, this one, but you know, if you're eligible, then what's that? $200 a week for a year? That's 10 grand off someone's wage. So it might be, you know, a good 20% if they're getting 50K a year. Alrighty. So moving on, we are halfway through our time limit here. So we have another concession or number of concessions around fringe benefits tax. So FBT is a bit of a pain to deal with if your business provides benefits to employees that are not tax deductible in general. So things like car parking, if they park near your work, attracted FBT. Now it no longer applies from the 1st of April 2021. So it is next FBT year onwards, and there's no FBT on electronic devices either. So like laptops and iPads and phones and stuff that you might give them, if they use them for personal purposes, then technically you should pay FBT on that. But they're scrapping the car park thing, and then also they're looking at no FBT on retraining or reskilling employees. There's a bit of detail to that one, but it's basically if you're looking to make someone redundant and you need to retrain them and that sort of thing, there's no FBT on that retraining or reskilling from the 2nd of October 2020 onwards. R&D backflip. This is one where the government's actually announced that they were reducing R&D incentives. So we've got a couple of clients who claim this, and they were kind of like, yeah, I just won't bother anymore. But this might actually interest people again. For small companies with less than 20 mil turnover, the refundable R&D tax offset will be set at 18.5% above the company tax rate, and there won't be any cap on the annual cash refunds. So that's actually pretty exciting. So just once again, they were aiming to cut the R&D tax incentives down a lot, and now they've gone, yep, here we go. You can have it essentially as it was again. Alrighty, number 7, apprentice commencements. So similar to the job maker hiring credit, a business that takes on a new or recommencing Australian apprentice will be eligible for a 50% wage subsidy. That's huge. The subsidy is paid in arrears and is available from wages paid from Monday to the 30th of September. Sorry, I think that's a typo. That should be likely 2021, up to a maximum of $7,000 per quarter. Sorry, let me just double check. Sorry, that is 2021. This number here. So apprentice wage subsidy from 5th of October 2020 to 30th of September 2021, up to a max of $7,000 per quarter. Next one here, and this, I think we're kind of towards the end here. Now, one for SMSFs, the maximum members in a fund for ages was 4 people in a self-managed super fund. And then a few years ago, they said, oh yeah, we're going to increase that so you can have up to 6 members in a self-managed super fund. And the original date for that was the 1st of July, 2019, but that never received royal assent. So it never turned into legislation. It was talked about and it's been on the cards for a couple of years, but the new date, and I don't understand this one really, but anyway, they're basically going, oh yeah, we should do that. We should get that sorted. But the new date is when it receives royal assent. So it won't retrospectively apply from the 1st of July 19. So whenever they get their act into gear and get that sorted, that's when we can add, maybe some of the extended family in your self-managed super fund. Whether we do that or not, it's not a question. But yeah, we don't look after many SMSFs that have 4 members even. It's quite rare for that to happen, but it does happen. So I don't know whether 6 is actually going to mean a huge deal. Alrighty, so that is basically the updates I thought were relevant for our clients. Again, just a reminder on our strategy call that you can do at no cost if you do have questions for our accounting team. And we did finish early, so we finished in 40 minutes. So I've got a bit of time for any questions that you've got, but I do hope that was helpful. And if you'd like to leave, that is totally fine. I won't be offended. But cool. Thank you for joining me this morning. And some great news for business owners. Thanks, Michael. Alrighty. Q&A is a question. Thanks, Jatine. Appreciate that. Thanks, Mark. And Lee, I'll just message you the info on the granny flat stuff. It basically gets rid of capital gains tax. Thank you, Steve. Con, if you are a sole trader, can you claim the apprentice subsidy? I didn't see anything against claiming it if you're a company. Let me just have a quick look because I do have the time. Thanks, Jen. Businesses of any size can claim the new wage subsidy for any new or recommencing apprentices or trainees that commence. So yeah, I can't see any carve-outs for sole traders, which is good, Con. David, I missed 3 secondhand assets. Does that include a secondhand car? Yes, David, it does include a secondhand car. If your turnover is less than 10 million, sorry, 50. If your turnover is less than 50 million, you can include secondhand assets. Also remember with buying cars that you've got your car limit of $59,000, which is another limit to consider if you're not a commercial vehicle. And thanks for joining, Tom. Yeah, I guess we'll be chatting soon. Thanks, Dan. Thanks for joining. Yep, it is very good news, David. Yes, I don't think business owners are going to be paying tax or much tax this year. You know, for a number of reasons. Hopefully, most of them positive. Also, just maybe a general guide. I actually wouldn't. There's the old one. Do you just spend money to save tax? Well, that's that. The argument there is: do I spend $1 to save 30 cents, 34.5 cents, whatever your tax rate is? I wouldn't just spend money for the sake of it, but if you're already going to commit to those assets, then this just makes it even more attractive, and it might tip you over the decision point where you go, yeah, okay, let's just do it because we know that we're going to get X amount back pretty quickly. It's pretty exciting. Jermaine, yes, we will be sending through the recording to this, so that should be sent through maybe this afternoon or tomorrow, that one. Steve. Yep, correct, Steve. Done at market value, etc. Thank you, Con. Yep, and as I mentioned, this is not the full budget. It's just the condensed version for business owners and high-income employees. It's like a 56-page document I got in front of me here. I just churned through that to to sort it out for business owners. Hey, Owen. Just while I remember, there's stuff on R&D incentives. I remember a conversation we had, and it might be worth reconsidering looking and applying for that stuff. They did the old backflip. I don't know if you've been on the whole call, but looks like a good one. Me too on the R&D. Thanks, Steve. Thank you, Steve. And your EMDG. There's actually EMDG changes if actually to both of you, really. Should have maybe included it. And Owen, you said, as it's now 18% on top of tax rate, are they lowering the company tax rate? So the tax rate is still 27.5% there for a company, Owen. So you're looking at, I need a calculator for this stuff. 18.5 plus 27.5 is 46% is your credit, and it's uncapped. How good. David, another webinar on R&D would be great. That would be a great idea. Although we're not experts on it, we usually refer on for that stuff. But I might be able to organise a specialist getting an expert on with me to chat through that stuff if there is the interest for it. How do you think the new tax bans impact the bucket company strategy? Great question, Owen. My thoughts on that is that our new magic number goes from 90K a year to 120K a year. So, if you've got a couple and we've got an extra 60 grand going to your personal names versus the bucket company. So I still think a bucket company is valid. It's just at what level of income. So, yeah, I guess it depends on your income whether we'd need one going forward or not. And future tax cut goes higher than 120K. Oh, I'd have to look that up, mate. Why not? I'll do it now. Actually, it might be difficult to find that quickly, Owen. Because they mentioned the tax cuts a few years ago, and if I Google it, it's all the recent budget stuff. So yeah, and again, I think if you're 300-400 grand upwards, I still think bucket companies are going to be quite helpful. The 300-400K upwards in family taxable income. Steve, Yeah. Hey, Steve, just with the JobKeeper eligibility for round two, what we've noticed is that out of our clients, and we've talked to other accounting firms about this as well, they're saying that, you know, about 80% of the people who were eligible for round one aren't eligible for round two. But we've seen a lot of instances where people who thought they weren't eligible didn't understand the alternative tests, or you know, we did a review and it was actually we needed to exclude some things that were counted in their GST stuff. So I don't mean that to be silly, but you know, there was some accounting adjustments we found in one client that weren't sales or GST, what they call them, GST sales. So if you do need help, we can help with that JobKeeper stuff, mate. It's even though you do use my. Oh, okay. And I completely cool. Yeah, good stuff, mate. So I'm just reading through and going. Owen, yes, MyOb does. Sorry, Steve. MyOb does slow you up. It's a filthy bit of software. Uh, Owen, it looks like I can't copy and paste that link, but that does ring a bell. That the could you be able to shoot that link in the chat box, right? Just instead of Q&A? Please, please. Thank you. Paywalled. Here we go. Okay. Yes. That does sound familiar. So it's not immediately that we're at that we are at stage 3, but it will be up towards that 200K mark. Now, keep in mind, so it's a 30% tax rate. Bucket companies are taxed, that depends on how you're structured, but 27.5 or 30%. So it actually will make bucket companies a little bit less, what do you call it? Less required to save tax. Very good. Cool. Alrighty. Well, you got to earn a few more mil. Absolutely, Owen. We want income to increase, mate. Yes. Awesome. Good to catch up on the. I think Owen and Steve have been fighting for the most engaged attendee title. You've got competition now, Steve. Awesome. Well, we've got a few more people still on, but I think that might be it for us. Thanks, Owen. Alrighty. Cool. All right. Have a good week, everyone. I will talk to you soon.